There are some new 2024 rules impacting your retirement accounts, taxes, medical expenses, and more. So let's just get right into it. Number one is Roth 401ks are no longer subject to RMDs. Up until now, people who got into their early 70s, they're forced to take out of their IRAs and their 401ks, and also their Roth 401ks and 403bs. Even though normal Roth IRA accounts, those are not subject to required minimum distributions, the 401ks that were Roths were. So kind of strange, but now that's fixed. The Roth 401ks and Roth 403bs are no longer subject to required minimum distributions. By the way, I forgot to introduce myself. I'm Dave Zoller, and if you're thinking about your retirement now more than ever, check out the 5-minute retirement below this video. Next is related to the 0% capital gains tax rate. Yes, there's a way to pay 0% tax on capital gains in your brokerage accounts. And as a quick refresher, short-term capital gains, those are investments held for less than a year. Those are taxed at ordinary income tax rates. But long-term gains, the investments held for longer than a year, those can be taxed at 0%. So imagine you bought a fund that was $50,000 and it grew to $100,000. That's great. But if you went and sold that, then you'd pay tax on the difference, which would be, you'd pay tax on $50,000. And you'd pay between 0 and 20% most likely. But now in 2024, single filers can earn up to $47,025 in taxable income before paying any long-term capital gains taxes. So that's that 0% rate. And for married filing joint, the taxable income is actually $94,000. So you can make up to $94,000 in taxable income before you start to pay tax on those long-term capital gains. As a quick reminder, taxable income is your adjusted gross income minus either your standard deduction or just your itemized deduction if you itemize. So let's pretend it's someone's first year of retirement and they've got money in the bank that they've saved up for this first year and to use to supplement income, and then they sold that $100,000 investment and they've got the 50K gain. Well, if they only had the bank income and their taxable income wasn't above, if they're married, $94,000, then they could potentially pay 0 tax on that 50K. This rule and other ones like it, they're very important when it comes to tax efficient withdrawal planning, which is one of the 3 keys to a successful retirement. That's the ones that, at least when it comes to our clients, it's tax efficient withdrawal planning or just income planning, and then tax planning overall. There's more than just tax planning when it's related to withdrawals. It really encompasses everything. And then there's the investment planning as well, because it changes a little bit. As you get to retirement, what you need the investments to do for you, it's no longer about getting the maximum growth needed, at least for our clients. It's more about smoothing the ride a little bit. But anyways, next is the IRS has increased 401k plan contributions in 2024. So I wrote these down for you. In 2023, 401k contributions were this, $22,500. They're going up to $23,000. And then for IRA contributions, they're going up as well. Now, there's also a catch-up contribution for both of these. For 401ks, the catch-up is $7,500 per year. And then for IRAs, the catch-up is $1,000. That's for people who are over 50 years old. They can do this special catch-up contribution to those accounts. And then there's this other thing related to Roth contributions. I don't know if you've heard of the income phase-outs, but the income phase-out for Roth IRAs, which means you can contribute to a Roth up until you get to a certain level of income. So those are here. They're going up from $138 to $146 for single filers, and it's going up to $230,000 for married filing joint. Anything under that, go ahead and contribute, and you should be okay. And with all of these things, you should double check, talk to the tax expert or talk to your financial advisor, and just make sure that you're doing everything correctly before making any decisions. The next one is starting in 2024, money in your 529 account that goes unused can be rolled over to a tax-free Roth IRA for that beneficiary. So now there's some rules here too. The 529 has to be open for at least 15 years. And then also the rollover maximum amount is $35,000. So there's limits there, but that's kind of nice to know that you've got a place to go. If you're, say you're giving to your grandkids 529 or starting one out for them, and maybe you think that they're a baby genius and they might not need any tuition payments because they'll get a full ride. Well, this might give you some peace of mind knowing that, you know, up to $35,000, they could roll it over to their Roth IRA in the future if they don't use it. Next is Medicare Part D premiums are expected to increase between 42% to 57% among the 3 leading providers in the top 5 states for seniors, which those top 5 states are California, Florida, New York, Pennsylvania, and Texas. And this is according to a recent study by HealthView Services. The increased costs come as new changes were put into law through the Inflation Reduction Act. That's going to lower the out-of-pocket maximum drug costs for seniors to $2,000 in 2025. That's down from $7,000 in 2023. So those are just 5 things, something to keep in mind as you're planning out retirement this year. And if you're looking for more help in making your retirement the best stage of life yet, then don't miss these videos here. And take care.